Hello, ARS family. I'm Andrew Oak, Executive Vice President of Aviation Retirement Strategies and ARS Private Wealth. On behalf of Alex Tapia, Melissa Brennan, and the rest of the ARS team, thank you for joining me. After a tough start for stocks in 2022, most are looking for reasons to expect a rebound. After no more than a 5% pullback last year, and the S&P 500 having more than doubled off the March 2020 lows, we have been anticipating more volatility. That doesn't, however, make this dip feel any better, especially with the pace of the market movement. As a reminder, our deliberate planning process specific to each of you plans for these market downturns. While the circumstances vary, our consistent focus is to work with you through these times of uncertainty and be available to answer any specific questions you may have about your accounts and their role in your personal plan. Today we look to cite some reasons we don't expect this sell-off to go a lot further and describe potential catalysts for a turnaround. But first, let's recap. It's been a rough few weeks for the stock market. Fears of rising rates and the Federal Reserve pulling back its stimulus more aggressively than previously anticipated to fight high inflation have caused most of the market jitters. Though earnings season, albeit in the very early stages, hasn't helped either. The pain has been particularly acute for the many growth stocks that make up the NASDAQ composite, which has corrected over 19% from its November 2021 high. This is the third worst start to a year ever for the NASDAQ, which is down 12% the year to date. Small caps have been hit even harder, with the Russell 2000 index nearly in bear market territory with its 21% decline since November 8, 2021. Higher interest rates and less accommodating monetary policy from the Fed amid stubbornly high inflation are getting most of the blame, and probably deservedly so. But another reason for the rough start to this year could be policy-driven. It is a midterm election year, which typically brings more volatility and smaller gains. Although we would argue these midterms may bring less uncertainty than some others in recent decades, given gridlock appears more likely than not to most political strategists, policy uncertainty is still there, and the environment remains divisive. As a result, we would not be surprised if this year ended up looking more like the typical midterm year, with mid-single-digit gains for stocks and a better second half of the year. It will take time for the biggest clouds of COVID and inflation to clear, and stocks have historically seen very strong rallies after midterm elections pass. So what might turn this market around? Stabilization in interest rates would help. The 10-year Treasury yield's inability to break through 1.9% last week and subsequent dip below 1.8 is a good start. Stock valuations are interest rate sensitive and harder to justify if bond yields go much higher. While inflation is clearly a key risk for markets right now, the data likely won't change much when January is reported in February. However, we could soon see more evidence of easing supply chain bottlenecks and more people jumping into the workforce as COVID disruptions hopefully fade. When the market begins to gain more confidence that inflation will start coming down, hopefully as winter turns to spring, inflation may turn from the stock market detractor to a contributor. A Fed meeting this week without any negative surprises, along with stable or lower oil prices, could also help. What about earnings as a potential catalyst? As we suggested in our 2022 outlook, earnings growth would likely be the primary source of stock market gains this year. The downward pressure on stock valuations from higher interest rates makes that more likely. We expect 2022 to look more like the mid-cycle mid-2000s or mid-2010s, with more modest returns, more contributions from earnings growth and dividends, and little, if any, contribution from valuation. That begs the question whether corporate America has enough earnings power still left in the tank to get investors excited about buying this latest dip. Still, we lean towards the rest of earnings season providing some support for stocks for these reasons. Despite these challenges, with about 70 S&P 500 constituents having reported, index earnings are still tracking to 5% upside, in line with the long-term historical average. Profit margin assumptions baked into analyst estimates appear to reflect these challenges, increasing the likelihood of mostly positive market reactions to results. Despite a likely smaller upside surprise than in recent quarters, an earnings growth rate potentially in the mid to high 20s for the quarter is still impressive. Estimates for 2022 have been holding up well. Historically, earnings estimates fall during reporting season, which isn't happening so far. This volatility we've seen this year is uncomfortable, but it is well within the range of normal based on history. The S&P 500 has averaged 3 pullbacks of 5% or more per year and 1 correction of at least 10% per year over its long history. In fact, the average max drawdown on the S&P 500 in a positive year is still 11%. After just one 5% dip last year and huge gains off the 2020 lows, we were due for a dip. However, based on the still solid overall economic and earnings backdrop, our expectation that the inflation clouds may soon start to clear, and the stock market's historically solid track record early in Fed rate hike cycles, we wouldn't expect this pullback to go much further. We continue to see fair value on the S&P 500 at year-end at between 5,000 and 5,100. Thank you again for joining me for this timely topic, and stay tuned as we continue to communicate as much as possible with you. We encourage you to contact us directly with any questions you may have at any time, and as always, thank you for your trust and partnership.